Hello, everybody, and welcome to the Like a Tortoise channel. Very happy to have you here once again. And today, I want to keep pressing. I want to keep talking about PayPal and why I think this is such a hidden gem in today's inflated stock market. But before I do that, thank you so much for the ongoing contribution for those of you who have been following the channel for a while. And if you are still new and watching this for the first time, welcome. And I do hope you make the most of every single video that we put out. The goal is to continue to expand our reach and to communicate with other like-minded people, of course. So if you are here, that you know that we are all about selecting, identifying, and investing in great companies trading at significant discount to the real value, right? Only with a margin of safety. And I think PayPal fits all the criteria, guys. Okay, so we have to talk about this once again, and you will have to thank me later on if this thing really goes ballistic, as I do believe it will at one point, just like Alibaba did when nobody believed in it. Okay, so I put everything together in a Word document, just trying to combine the essentials of this company and why I think this is such an incredible opportunity. And again, it makes me feel excited about being an investor, because the only place where we investors can find these big discrepancies between value and price is really the stock market, because people select stocks without thinking about the underlying business, right? But this allows us patient long-term investors to make a lot of money. And so why do I think that PayPal is such a deep value hidden in plain sight? Okay, let's walk you through everything. PayPal continues to be one of the most misunderstood and undervalued companies in the market, in my opinion. This is a company that, despite improving fundamental strong capital returns that have been improving, in the network of nearly a network effect nearly impossible to replicate. Let's not forget PayPal has over 400 million active users, combining both merchants and consumers. Despite all of that, the stock trades at levels that imply the business is in a structural decline, a narrative that simply is not supported by the data. So let's talk about the main things that really jump out at me whenever I look at PayPal, just to reassess my thesis. I, I mean, I become even more bullish on this company. Number one, PayPal valuation is crazy cheap. You can see that the market right now, as if I go here, the forward P is only 11 times and the P ratio is currently 12 times. Okay, this is ridiculous. Okay, you can see that at 11 times forward earnings, this is about 60% cheaper than the S&P 500. Let's not forget the current PE of the S&P is around 29 times earnings, so significantly cheaper. And not to mention the fact that it's trading at a fraction of the price of Visa, currently at 26 times earnings, MasterCard 33 times earnings, and Block 26 times earnings. Now listen, do I think PayPal can come close to matching Visa and MasterCard business modes? No, I'm not suggesting that. But what I'm saying is that this discrepancy needs to be narrowed. Okay, it doesn't make any sense to me that a company is still growing, um, that a company is still growing, is in fact growing faster, from certainly from an earnings per share basis than Visa and Mastercard deserves to be trading at such a steep discount. Okay, and okay, so and it's well below its own historical average. This is also important. In fact, if we have a look at the PE history of this company over the last 5 years, let's go here to our stock analysis. Let's go to ratios. Let's use the annual. That can happen. Okay, look at the PE. So you can see that the PE continues to trade lower and lower. In 2020, 2021, 53 times, 65 times, and now we are at the lowest point in the company's history. So it does imply that the company is declining when the fundamentals are telling you a different story. All right. If I go here to my stock unlock platform and I put PayPal on the screen, look what happened. Does this look like a company that is dying? Let's change this to the annual. What am I doing here? No, sorry. I want to see this PayPal. Okay, financials to yearly. Let's have a look at the income statement. Look at that. Revenues. Since 2019, they have been compounded by 12.32%. All right. Look what happened to net income. Even if I scroll further back, even if I zoom out further, look at that. Since 2017, net income compounding at about 12.7%. And look what's happening right now. This number right here, quite 4.1 billion. You can see that it's currently at one of the highest levels in its history. And it's, if I flip this to the trailing 12-month charts, look at this beauty. Remember, guys, that Alex Chris started as the new CEO at around September 2023. Since this guy took the helm of this company, net income, which in other words profitability, has been going higher, and it's right now at one of the highest levels in its history. All right, keep that in mind. Look at the balance sheet of this company as well. Take a look at in fact, I will just flag the most important things, because if I go here, look at that. Where is that? We will touch upon that later on. But look at this. Assets, change this to the yearly. Look at how nice this has been. About 10% over the last several years. Total cash and cash equivalents also going very high, also at very high levels. And the reason it's declined a bit is simply because the company has been using some of that cash to do a lot of buybacks, which is something that I really, really love, because PayPal is a cash flow machine, produces a lot of cash, and it makes sense to deploy that money both to reinvestments, to buybacks, and now they're going to start paying a dividend, which we will cover later on. Look at the retained earnings. How about that? 32% compounded since 2017. Monies that the company doesn't have to pay out, does not pay out as dividends, that accumulate on a yearly basis. This is just incredible. It continues to go up. Free cash flows. Look at cash from operating activities. Look at this amazing jump here at its all-time highs. Very profitable, the operations of the business. If you look at stock-based compensation, since Alex Chris took over at the end of 2023, you can see that stock-based compensation has been slowly but surely trading lower. I love to see that. All right, very important. Another important thing to say: look at the free cash flow, guys. Fantastic. They are guiding for 6.5 billion, between 6.5 billion and 7 billion free cash flow by year end, which will make it the highest. Which will make it, in fact, look at this, about 6.7 billion, the highest level the company has ever showed. Okay, for free cash flows. That is incredible. Does it look like a company that is dying? Free cash flows compounded at 20% since 2017. I mean, in my world, this is fabulous. Okay, fabulous. Sure enough, inside Stock and Log gives it a 3.65 out of 5, which is a pretty good score. And you can see, let's continue doing our analysis right here, well below its historical average. Because if I go here to financials and change this to metrics, look at the price to earnings ratio. Okay, since 2016, this is the highest level. Only lower than that was back in 2023, when the company hit its all-time lows. Right, but look at on a price to free cash flow basis, already trading at the lowest level ever. All right, it's so cheap. But we will talk more about valuation levels going forward. What are some potential catalysts for the company to go ballistic? Okay, and remember, Black Friday and holiday tailwinds are great things for sure. but they are not something that is they can work as catalysts, but but I mean, ultimately, you want to see the fundamentals of the company improving because that's going to create long-term sustainable growth. But still, and we are seeing that. But some positive catalysts, short-term catalysts, include Black Friday and also holiday tailwinds. All right, Black Friday online sales for 2025 are estimated at almost 12 billion, which is an 8% increase compared to last year. And this matters for one reason: PayPal touches almost everything in online checkout. And so, with Black Friday, Cyber Monday, holiday shopping, quarter four structurally benefits the business. The market often forgets that PayPal is one of the purest plays on global e-commerce activity. And as you know, they are transitioning their business model from a pure payment solution provider to a full-blown e-commerce player. Okay, earnings outlook and financial strength. What's interesting about the earnings estimates is that our analysts are constructive. If I go here to PayPal, for example, to my stock analysis, and if I go to statistics, you can see that earnings per share growth for the next 5 years is estimated at 18.26%. And if you go to FinChat, you can see that the long-term projection sits at around 14%. That's not the company that is dying. Look at the growth forecast for revenue, almost 10%, almost 7%. Okay, so okay, let's continue. Analysts expect solid EPS growth over the next several years when combined with an 11 times earnings multiple. PayPal screens as one of the cheapest large cap growth companies in the entire market. Look at the balance sheet. This is what I wanted to discuss. They have, if I go here to the financials, you can see trailing 12 months. They have about balance sheet. Bear with me. Look at that. Cash and cash equivalents about 10.755 billion. And then you can see that total debt sits at about 1.6 billion. Okay, so this is a company that could essentially, if they wanted to, they could pay almost the entire debt from its current cash position. And you know that that is very important to me. And sure enough, if I go to statistics, look at some of the metrics regarding that. Debt to equity 0.60, less than 1. Debt to free cash flow 2 times. I love that. Why? Because it means that if the company wanted, it could pay all of its debt from current free cash flows in about 2 years. All right. I love seeing that. So the balance sheet is very strong, and so are the returns on equity at about 24 times. The returns on invested capital at about 11.66%. I like to see these metrics trading above 10%, and that is certainly the case for PayPal. But most importantly, when playing a turnaround, we want to see that these metrics are improving or declining. All right, let's have a look. If we have a look at their ratios, look at ROIs going sharply higher. So the company is becoming more effective at deploying capital, which is very good. It's by far the most important task of management. Look at the return on equity at one of the highest levels as well, in moving upwards. I love seeing that. Okay, so this is very good. Okay, again, it's the current management team is doing a very, very good job. Yeah, and so we already discussed that, and this will give them plenty of flexibility to do buybacks and to invest back into the business. All right, far stronger than the market is pricing in. That's the main takeaway here. Capital return, shareholder-friendly management. They initiated a dividend, as you know. PayPal announced its first ever dividend of 0.14 per share, which is about 1% yield. So yeah, at current prices, and this matters because it signals confidence from management it expands the potential investor base. Why do I say that? Because remember that there are some ETFs that solely focused on dividends. And so if they start buying, they're going to have to start buying PayPal as well because it's now a dividend paying company. Yeah, that can be that can be another catalyst for both the company and shareholders. All right, it reflects a maturing cash generative business. Dividend growth potential is high over the next 3 to 5 years, but I didn't invest in a company because of the dividend. In fact, I as far as I'm concerned, I would rather the company stick. I would rather the company retain that capital and just do more buybacks or more reinvestments, but it's not going to do any harm because the yield is very low. All right. 20 billion buyback program. The company has about 4.86 billion remaining from the 2022 outlook, plus a new $50 billion authorization. Okay. It was authorized early this year. This means the total repurchase capacity is about 20 billion, which at current market cap, right? What's the current market cap of PayPal? Is about 58.55 billion. So if we do 20 divided by 58.25, I mean, this is ridiculous. Look at this, like 34%. Yeah, so it's about, yeah, 1/3 of the company's market cap. This is absolutely insane. Management is openly signaling that PayPal shares are deeply undervalued. Otherwise, they wouldn't have committed so much capital towards buybacks. But what's interesting is, again, the sharp contrast between PayPal's valuation and the other players. And look at Stripe, guys. I was looking at this the other day. Stripe, as you know, is not publicly traded, and it's a private business and a direct competitor to PayPal. Now, Stripe is valued at about 107 billion, and they only generate $5 billion of revenue. PayPal has a market cap, so is valued at 58.55 billion and generates $32.86 billion in revenue. I mean, this is absolutely ridiculous if you ask me. What that means is that the discount between PayPal's scale and its market valuation is monstrous. Stripe's valuation alone highlights how irrationally cheap PayPal has become. PayPal has a much wider network compared to Stripe. It has a much longer track record. Okay, it's been around for a long time, and those network effects and the resilience of its network and is really significant discounted if you ask me. Okay, you have massive network effect, over 400 million active consumers, 35 plus million merchants, global brand and recognition, high checkout conversion rates. This network effect is very difficult to disrupt, all right, and certainly to replicate. Product and strategic improvements, another thing that the market is completely dismissing. What about all the partnerships that PayPal has been entering with the likes of, for example, Perplexity, Google, and so on and forth? Okay, so I mean that's not priced in. PayPal's quarter 3 outlook results showed what? Stabilizing growth, improving transaction margins, very important, higher engagement, solid operating execution. Management clearly believes the turnaround is working. The new dividend and massive buyback authorization reflect that exact confidence. Are there risks to the stock? Yes, but before I delve deeper into them, let's quickly do a very quick valuation exercise here. And if you don't know Manish Pabrai, he uses a formula for cannibal stocks. And I created a video not that long ago about this, so feel free to go back and watch it. But look at this. PayPal currently has about 960 million shares outstanding. Okay, good. Let's consider a realistic scenario here. The company deploys 4.5 billion per year over the next two years, which is what they already said they will be doing. And let's assume that the price seats continues to be at around 70. Right now, it's even lower. You can see here, PayPal is trading at $62 dollars per share. Okay, but let's assume it achieves an average price of 70 over the next 2 years. This would reduce the share count by approximately 128 million shares over that period. How did I do that? 4.5 plus 4.5, that's 9. Okay, and then so that's 9 billion that they will be spending over this 2 year period. And if you do 9 billion divided by the share price of 70, then they could they could buy approximately 128 million shares over that period. Then let's assume over the subsequent 5 years, the average price of PayPal is about $90 per share, and that they continue to repurchase, say, $4 billion worth of shares per year. 4 times 5, that's 20. Okay, so that means 20 billion divided by 90. That means you would retire an additional 222 million shares. In total, over this 7 year period, this means this would reduce shares. It will mean that PayPal will repurchase 350 million shares over the 7 year period. That's a 36% reduction in the share count, right? Remember, we started with 960 million. We are now down to 350 million. Divide one by the other, that's a 36% reduction. This implies shares outstanding declined from 960 to roughly 610, meaning 64% of the current share count remains. So, where does Monish Pabrai's Cannibal formula comes in? Right here. You do the earnings growth for the company times brackets 100 divided by the share percentage left, close brackets, times multiple expansion, right? So I'm assuming earnings growth at 14% per year. And remember, some analysts are estimating 18%. So I'm being conservative. So earnings growth at 14% per year, that compounds to 2.5 times over 7 years. You just need to do this formula right here. Okay. What about the share reduction? So let's do that. 100 divided by 64, which is the share percentage left we discussed above, 64%. That means 1.56. Valuation multiple, let's assume that the valuation expands from 14, which is its current level, to about 20 times. In 7 years, that means you will have 1.428 times. Now, let's add everything. And if you do that, you can see that you can expect a 5.491 times return over that 7 year period, which means a 27.55% annualized return. Okay? And remember, I used conservative numbers in my assumptions here. All right. So I mean, it just goes to show how cheap this company is, guys. And look at another thing that I want to share with you. If I go here to financials, let's go here. Okay, so the market cap, let's say we want to double our money over the next 5 years. The market cap is around 58.55. So if we do 58.55 times 2, we get 117. Let's assume in 5 years the PE is at 20. If I divide this by 20, I get 5.8, 5.9 net income. What's the current net income of the company? If I go here to the income statement in the trailing 12 months, the net income of the company currently sits at about 4.917. All right. And what have been the margins for the company, the profit margin of the company over the last few years? Right now, if we just use, for example, you can see that the profit margin sits at about 14%. Let's call it 15%. So what can I do here? I can do something that I will tell you right now. What I can do here, bear with me 1 second. You just need to do 5.85. Do this number divided by 0.15, and this means 39 should be your revenue. Okay, and current revenue, as you can see right now, sits at about 32.86. So the question is, do I think PayPal can grow its revenues from 32.86 to 39 over the next 5 years? What is that in return from what is that returns wise? Let's have a look right here. So the starting value is current revenue, which is 32.86, and now 32.86, and now we're going to have the ending value of about 39, right? That's what we were discussing, 39 over the next 5 years, which means revenues would have to grow only at by 3.49% per year for us to double our money over the next 5 years. I mean, this is ridiculous. Okay, this is a company that has been growing revenues. Let's have a look. As I mentioned right here, even if we just do it from 2020, yeah, look at that. From 2020, total revenue has been compounded by 10% per year. Okay, so do I think PayPal is cheap, very cheap relative to its fundamentals? Absolutely yes. Do I think the fundamentals are improving and the market is sleeping on the wheel? Absolutely. In other words, this is a company that, guys, that if this thing were to come down further, I always use again, I always use eToro for educational purposes, but I want to show you this. If this company was to come down to test the 52-week lows of about $51 per share, I would be loading up again. Okay, I would be once again loading up the truck. And by the way, that would be, from a technical standpoint, that would be very bullish because it will probably mark a double bottom, and that double bottoms are very powerful because they signal reversal. Okay, so guys, sorry for the length video, but I wanted to share everything about PayPal, certainly why I remain constructive, why I'm not selling a single share, and why I would consider buying more if the recent all-time low was reached. If you found the video helpful, please, guys, just smash the like button. It really helps us grow. And let me know what other companies you would like me to analyze, and I will for sure deliver more content. Thank you so much. Smash that like button if you enjoyed. Stay safe.